Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of how to use the P/S ratio to find growth stocks. Understanding the price to sales (P/S) ratio, a guide for investors. Ever wondered how investors compare companies without overcomplicating things? The price to sales (P/S) ratio might be your answer. It's a straightforward metric that helps investors understand how much they're paying for a company's sales. This ratio offers a snapshot of a company's value, particularly in industries where earnings might not tell the whole story. Whether you're a seasoned investor or just starting your investment journey, grasping the P/S ratio can sharpen your decision-making. It highlights whether a company's stock is overpriced or undervalued compared to its sales. So, if you're keen on maximizing your investment strategy, diving into the P/S ratio could be just what you need. What is the price to sales ratio? When evaluating potential investments, the price to sales (P/S) ratio is a handy tool that investors rely on. This metric offers a simple perspective on how much investors are paying for each dollar of a company's sales. Unlike complex jargon-filled metrics, the P/S ratio keeps things straightforward and user-friendly, which is especially valuable when earnings fluctuate or don't fully capture a company's performance. The formula behind P/S ratio. Understanding the components of the P/S ratio is the first step in seeing its benefits. The formula is quite simple. Text, price to sales ratio, equals, frac, text, market capitalization, text, total sales. Let's break it down. Market capitalization. This is the total market value of a company's outstanding shares of stock. You calculate it by multiplying the company's current share price by its total number of outstanding shares. It reflects the market's perception of a company's future prospects and performance. Total sales. This refers to the total revenue generated by a company over a specific period, usually measured annually. It showcases the company's ability to attract customers and generate income. By dividing market capitalization by total sales, investors can see how much they're paying for a company's sales, offering a simplified view of valuation that doesn't depend on profits, which can often be misleading. Why use the P/S ratio? The P/S ratio shines in several scenarios, offering distinct advantages over other valuation metrics. Let's explore why you might favor it. Simplicity. Unlike more intricate metrics, the P/S ratio is straightforward and easy to calculate. You don't need to get tangled up in complex accounting figures, making it accessible for both beginners and seasoned pros. Relevance. In industries where companies might not yet be profitable, think startups or tech companies in rapid growth phases, the P/S ratio still provides meaningful insights. Traditional metrics like P/E ratios don't work well when earnings are negative or irregular, but the P/S ratio remains relevant. Comparative analysis. It enables investors to compare companies within the same industry without the noise of variable earnings. The P/S ratio helps pinpoint which companies might be undervalued compared to their peers. Downturn insight. During economic downturns, when profits take a hit, the P/S ratio continues to offer a stable comparison metric. It reflects the business's ability to keep generating sales even when profits slide. Incorporating the P/S ratio into your toolkit can add depth to your analysis. It serves as a quick, insightful gauge of value, offering perspectives that earnings-focused metrics might miss. So, the next time you assess potential investments, the P/S ratio could be your secret weapon. How to calculate the P/S ratio. Calculating the price to sales P/S ratio is straightforward. It's about knowing the right steps and having the correct data ready. This ratio gives insight into how much you're paying for each dollar of a company's sales. Let's walk through the process of calculating it and then apply it to a real-world example. Step-by-step calculation process. Understanding how to calculate the P/S ratio comes down to a few key steps. Make sure you have the right data on hand to keep things smooth. Gather market capitalization data. Find the current share price of the company. Determine the total number of outstanding shares. This information is typically available in the company's latest financial statements or on financial news websites. Calculate market capitalization by multiplying the share price by the total number of outstanding shares. Obtain total sales data. Look for the company's total revenue or sales over the past year. Most companies report this in their annual financial reports, usually referred to as the income statement. Calculate the P/S ratio. Use the formula text P/S ratio equals frac text market capitalization text total sales. By following these steps, you can easily compute the P/S ratio for any publicly listed company, providing quick insights into whether the company's stock could be over or undervalued based on its sales. Real-world calculation example. Let's put this process into action with a hypothetical company, ABC Corp., which we're evaluating for potential investment. Determine market capitalization. Current share price, $50. Outstanding shares, 10 million. Market capitalization. $50 times 10 million equals $500 million. Assess total sales. Annual sales, $250 million, as reported in ABC Corp's annual financial statements. Compute the P/S ratio. Text P/S ratio equals frac 500 text million 250 text million equals 2. ABC Corp's P/S ratio of 2 means investors are paying $2 for every dollar of annual sales. This figure can be compared with peers in the same industry to understand valuation contextually. With the P/S ratio calculated, you're better positioned to make an informed decision about the potential value and investment opportunity of ABC Corp. Remember, the P/S ratio, while informative, should be used alongside other metrics for a comprehensive analysis. Interpreting the P/S ratio. The price-to-sales P/S ratio isn't just a formula, it's a peek into how the market views a company's sales in relation to its valuation. Understanding this ratio can offer insights into how a company is performing and how it's perceived by investors. In this section, we'll uncover what low and high P/S ratios suggest about a company and how these ratios can vary across different industries. Low versus high P/S ratios. When you see a low P/S ratio, it's like finding a hidden gem in a thrift shop. It can mean the stock is undervalued or not in favor with investors, which might occur if the company is struggling or if market conditions are tough. However, a low ratio can also signal an opportunity. Investors looking for value might see potential in stocks with lower ratios, especially if they believe the company is underappreciated by the market. On the flip side, a high P/S ratio can be a siren call to investors with a more speculative mindset. A high ratio often suggests that the market has significant expectations for future growth. It can be linked to high-performing sectors like tech or biotech, where future prospects outweigh current sales numbers. But beware, these stocks can be priced for perfection, and any misstep might lead to sharp declines in value. Ask yourself, do you like a discount or are you willing to pay a premium for potential? The answer can guide your interpretation of a low or high P/S ratio. Industry variations in P/S ratios. Not all industries are created equal, and this holds true for P/S ratios. Some industries traditionally exhibit higher P/S ratios due to their growth trajectories. For instance, tech firms often have a higher ratio as investors bet on future innovations and expansion. The same goes for sectors like healthcare, particularly biotech, where groundbreaking drug development promises significant future returns. In contrast, more established industries, think utilities or manufacturing, tend to display lower P/S ratios. These companies often have stable, predictable revenues, with less room for explosive growth. Investors might find lower P/S ratios here, reflecting the mature nature of these industries. Here's a quick glance at some P/S ratio tendencies by industry. Technology, usually high, driven by innovation and growth potential. Healthcare, biotech, generally elevated due to the promise of future breakthroughs. Retail, moderately low, sensitive to consumer trends and economic cycles. Utilities, low, reflecting steady but slow revenue growth. Reflect on the industry before drawing conclusions from the P/S ratio. Different sectors have different stories, and the P/S ratio is just one chapter. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.